Good day and welcome to Trader's Edge. To our viewers and listeners out there, it's always a pleasure having you tune into our show. And on today's episode, we're going to be talking about technical analysis versus fundamental analysis. Which is the more powerful? Which is the more important? Do both of them work? Do any of them work? Should you even pay attention to any of that? Or should you just shoot in the dark? We are hoping to answer all of those questions with my colleague and co-host, Sihle Tuta, our commercial director at Exness, and myself, Terence Hove, senior financial market strategist at Exness. Thank you again for tuning in, and remember to follow us on all our social media pages. Don't forget to subscribe, like, and leave a comment there to come back to you on maybe a particular topic you'd like us to talk about. Sihle, how are you doing, mate?
Good on yourself, Terence. How have you been?
I'm very well, thanks. And today, it's that whole conversation that even internally, it's always back and forth and etc. What is more effective? Fundamental analysis, technical analysis? Does it even matter? Can you use any of them? Should you even consider any of that stuff as a trader? I mean, does it mean anything? I mean, what's your view on that?
What is a better child, a boy child or a girl child? Look, I believe that both styles have their merit, but they equally have their weaknesses. Some traders prefer to purely trade technical, and some traders prefer to purely trade fundamental. But I think, personally, technical analysis works for me, but you need to watch your economic calendar because sometimes the market will ignore a purely technical setup on the release of economic data. Right? So you need to factor in both styles. You cannot use the one and ignore the other. I find that people who trade purely fundamental are more on the risk side, more on the gambling side.
Okay.
Because you're basically waiting for a specific economic news release and then you take a position. So you're basically more on the gambling side. However, I don't totally dispute purely fundamental traders because the fundamental trading does have its merits. So I think you need to consider both.
Okay.
What are your thoughts?
Yeah, I mean, that's opening a whole bag of debate. But my thought is technical analysis is viewed as studying past price action patterns to determine future ones.
Yeah.
You know, and I know the age-old saying history repeats itself, which gives credence to technical analysis, if we call it that. But while history might repeat itself, it does not necessarily repeat itself in the same way it did the last time.
Yes.
The previous time, the last time. And because of that, the patterns will be different, right? What I think might be repeated is the price is going to go down or up.
One of the two.
One of the two. And you don't need to be a rocket scientist to figure that out. I mean, financial markets are not linear. They don't just go up one way, down the other way. They are up and down. They're both buyers and sellers at the same price. So the belief of studying past price action to predict with some reasonable degree of accuracy of what's going to be happening in the future is, to me, very mystic, you know, because the price is going to go down. But what is causing it to go down is what you need to be aware of, which is where I think technical analysis falls short. It fails to explain why the price is going down. They could say, look, the market was overbought, it was oversold, that's why this and that, buyers have come in, sellers have come in, it's moving to this level, to that level, and all of these things. But the key drivers to the price action, it falls short of explaining them. And sometimes you can't actually pinpoint what the actual driver is.
Okay. Which group of traders do you think are more successful? This is just an opinion, right? More successful between fundamental traders and technical traders?
Oof. Yeah. I've seen fundamental traders being exceedingly successful.
Really?
Yes.
Okay.
And I think what I'm careful to do is explain there's what people think fundamental analysis is out there in the trading communities and what it actually is.
Okay, maybe let's take a few steps back
Yes.
and define
Yes.
what fundamental trading is and what technical trading is, or what fundamental analysis is and what technical analysis is.
Yes.
Can you clarify that for us then?
So under fundamental analysis, I think the answer is in the word itself, fundamentals. You're looking at the essence, the foundation of a particular instrument or asset class, what drives it. And the driving is both forward and backwards, both negative and positive. What affects the price? So knowing what those factors are is what fundamental analysis. So under that umbrella is economic analysis, which is economic data. There's economic data, which is often termed as a risk event, but it's economic data from the economic calendar. Then there's the actual economic analysis on what that data is going to do to the market and eventually to that particular asset class or instrument. Under fundamental analysis as well, there's sentiment, there is geopolitics. There's all of these factors that come together to affect the actual instrument and asset class. That is what, for me, is under fundamental analysis. Let's simply call it the key drivers of an instrument and an asset class.
Okay.
Right? And then technical analysis is charting. Right? When you chart all forms of charts and the charts have got indicators, have got signals, and they've got all the different methods that are out there that can be used. Disclaimer, all of them are successful.
Okay.
Right? All of them are successful if you follow the disciplines well. But there's one that tends to out-trump the other. Provided you are following the disciplines well. And the disciplines are the right risk management, the lot size, scaling up, when to scale up, all of these different factors. And once all of these are considered, or else being equal, right? I think when you play to the key drivers and understand the drivers and their effects to an instrument or asset class, it positions you in a more powerful position rather than just what the chart would speak to without looking at the drivers. And the chart will always explain certain things without necessarily explaining the drivers, which is where the winning is. You can make your millions from charting. That's what technical analysis is. It's charting, and it's charting information, it's charting data. That's what technical analysis is. Back in the day, they used to call it tape reading. When you read the tape in those bucket shops, and if the tape says this, it does this, then you take a position. It's all forms of charting, right? And then, but when you then know that when the price goes this way, because the data came out this way, but this data is going to mean this and that at this particular time, you are able to take a more informed decision, right? That you are able to amplify for as long as it is going in the direction that you are anticipating it to go. The only time you close that trade is when the direction changes, and the confirmed direction change is actually given by it's past this particular level and it's continuing to go there and so forth.
So then my other question, just to throw a spanner in the works. So I once heard a very respectable commentator or trading author say that if you are a good technical analyst and you're a good trader, even if you use fundamental analysis, he says he can take the opposite of all of your trades, as long as he manages his risk, he will still make money.
Yes.
So he doesn't have any technical or fundamental knowledge.
Yes.
He just manages his risk. So every time you take a buy, he sells. Every time you sell, he takes a buy. But he just manages his risk. He argues that he can still make money.
Yeah.
What do you say to that?
So what risk is he managing?
Well, so for every trade he takes,
Yeah.
he goes in with a predetermined level of risk.
Okay.
So where you buy,
Yes.
he will sell, but put a stop loss.
Yeah. Okay.
So maybe let me put some perspective here. Most good traders will have a win ratio, say, of 50%, right?
Okay.
Which means you are wrong 50% of the time. So which means where you're right, he's wrong.
Yes.
Where you're wrong, he's right.
Yeah.
He's not analyzing.
Yes.
He's just taking your cue. Where you buy, he sells.
Yes. So look, I'll agree with that in principle of that at any given price, there's always a buy and a sell,
Okay.
right? And given that, that shows you that there's always different views of the market. And both of them are correct. The buy is going to make money, the sell is going to make money. And by virtue of that understanding, what the well-known trader and author has said is correct. He will make money simply by taking the opposite side of the trade. Because if I'm right 50% of the time, then that means of these trades that I've made, 50% of them are going to be right. And those that are wrong, he is going to be successful.
The opposite, yeah.
But this is like, provided he's entered at the same level, all of these factors, that's what we're playing at. So he's bought where I've sold, he's on the opposite side of the trade. And definitely, he will win because that's what the win ratio is there for, So that also in itself, Sitley, I think then answers the question, what is better, technical analysis or fundamental analysis? Or
I will take a position and say I will stick with technical analysis.
Right.
If I had to pick one, I would pick technical analysis with risk management.
Okay. So I'm going to be a true market strategist on this one.
Yeah.
And actually say both. I use both.
If you had to pick one, though,
If I had
so
to
pick a side,
If I were to pick one, I would pick fundamental.
Okay.
And I think why. The why is important as well. And I think it's also equally important for you, our viewers and listeners, to establish. And the key question is what works to your strength. That is the key thing. Both in terms of analysis, because what analysis is price discovery. You're trying to establish where you should enter and exit the market. That's what analysis ultimately comes down to. And so whether it's analysis and whether it's trading strategies, what speaks to your personality the most, to your behavior the most, and because all of it works, right? There's some who will tell you and show you the evidence of how well it has gone for others. And there's varying levels of success, but the key thing is it's all successful. So I think the personality is a big factor that will determine which works best. If you like quiet spaces, no noise, you'll find that technical analysis speaks more to you, where you are really focused and captured by the charting and whatever the charting is doing. And if you'd like noise coming from different angles and trying to make sense of what all of those different moving parts are, then fundamental is a lot more exciting. Different moving parts that you place in the different cubes, see the connecting dots and execute that. So it speaks to that personality, that you are. And hence, it's always a very difficult thing to say, this is what works best and that is what works best. And for the genuine traders that are out there, they rely on both. Not to say others are not more genuine than others, but you cannot confidently shoot down the one over the other. You can take a position with one because it speaks to your strength, to your ability, to your understanding. And that's why the most important thing I believe in trading is to have a view. whether you want to buy or to sell there. And it is, in my books, wrong for me to come to you, Sihle, once you have a view to sell and to say you are wrong. Because what makes me right? Because we can both be right and wrong. Yes, we can both be right and wrong at the same time because they are both buyers and sellers, and the price will go down.
Yeah, I think that's
and it will go up.
Yeah. I think that's the interesting thing about trading, right? Because I can sell and have a predetermined price level in mind, but before price comes to my level, it should first go up.
Yes.
Before it goes down.
Yes.
So when you say you're going to buy,
yes,
before coming to my sell, it's going to go up.
Yes.
Maybe to your buy.
Yes.
Before coming to my sell.
Exactly.
So yeah.
There we go. And to close that loop, one will then realize that, like you said, the one can happen before the other. And ultimately, what then I think people use to distinguish your ability to trade is your ability to catch the moves. The up when it's an up, the down when it's a down. That is essentially the essence of trading, which you catch sometimes and sometimes it catches you unaware. It's on the way up, it might not go entirely the way you think it would, but it did go up. It might go down, but not entirely the way you think it will go down, but it did go down. And that's where the balancing act in trading is. And ultimately, you're buying your sell in the right direction. Yeah. And well, Sihle, very interesting point, very interesting topic. I think we can always discuss it more and give more evidence to it. But we hope that, what we have discussed today gives you an idea and insights into what you should consider into establishing what works for you. And there is no right answer. It's ultimately what works for you. So from Sihle Tuta, our commercial director at Exness, myself, Terence Hove, senior financial market strategist at Exness, thank you for tuning in, and it's bye for now.
Cheers. Bye-bye.